Welcome to Investors Insights. Our topic today is payouts and rate cuts, ? I'm joined by my distinguished colleagues, members of our portfolio strategy team here at Five Plan Partners, Bobby Norman and Ty Miller. We have just finished a great session looking at data that we collected over the weekend in our research. And both of them brought some ideas to the table that I felt like we need to share this morning. And that's why we chose the topic, payouts and rate cuts. So many times, everybody wants to ask about the strength of the market or volatility of the market, but we've got some additional insight for you today. So, Bobby, you brought up the topic about dividends. And so often, like I said, people are interested, what's this stock performance? But there's another key ingredient in a successful portfolio that we look at here at Five Plan Partners. You want to talk about it?
Yeah, I want to give an update on dividend payouts. It's something that's been brought up with clients more recently. And so as bonds and money markets have been paying higher interest rates, we think it's important to cover dividends since they are an important part of total return in a portfolio. An interesting fact is that dividends have contributed to over 37% of the total return of the S&P 500 over the past 96 years. Again, that's a big number. Think about that. 37% of total return over 96-year S&P 500 performance has been from dividends. So again, dividends have played an important part in total return. So it's something we follow closely. And so looking at this chart that breaks down the current dividend payouts, currently 403 out of 503 companies that make up the S&P 500 currently pay dividends. This chart actually breaks down dividends by each sector. And so of the 11 major sectors that comprise the S&P 500 index, 8 of them have yields above the 1.46% generated by the index that you can see in this chart here. As you can also see, financials, information technology, and healthcare contributed the most to the index dividend payout at 15.75%, 15.2%, and 14.6% respectively. And so obviously it's something that we as investment managers follow closely in the payout ratio for the S&P 500, which stands at 36% as of last year. So again, 36%, keep that number in mind. A dividend payout ratio between 30 and 60% is typically a good sign that a dividend distribution is sustainable. So right now, we think we're on good footing. Also, there are a total of 25 dividend cuts and 4 suspensions in the index last year. For comparative purposes, that's actually gone up, and considering the fact that we didn't have a single dividend suspended in 2022, and only 5 dividend reductions were recorded over in 2022. So again, we're watching it carefully here. It's something that we need to monitor because dividend payout ratios have historically been a really good indicator of economic and corporate strength. So again, we'll continue to keep you updated on dividend payouts.
Well, and you make great points there, Bobby, because also in the portfolio strategy side, especially as people retire, those dividends not only play a key role in return, but that's also some cash flow that can be added to the portfolio from those dividends. Mm-hmm. And so I thought it was outstanding what you had done there. And Ty, when Bobby brought up about bonds and money market, you interjected in our meeting about the Fed and possible rate cuts. That's why we did the question mark at the end of our title today, payout and rate cuts. Talk about that in relation to people's bonds and money market accounts and what we think is going to take place.
Yeah, it's one of the hottest topics right now is what the Fed is going to do going forward. And so they met last week. To no one's surprise, they kept the rates the same between 5.25% and 5.5%. There was no rate cut expected this time. But more importantly was their commentary to lead into March. March was kind of the first maybe expected rate cut coming up when we came into the year here. And the Fed kind of tampered down those expectations, saying that, employment's still strong, inflation is still above their target of 2%. And so kind of the odds of a rate cut happening in March plummeted. So they're at 15% roughly right now, 85% chance that they just hold. There's no rate hike on the table right now, but just holding at this current range for March appears to be the most likely thing to go forward, and then we'll see how that kind of impacts the rest of the year. I have a chart here that shows 1 month ago what the implied rate was. As I mentioned, we coming in the year, we're expecting 5 or 6 rate cuts. We're still in that 4 or 5 range of expectations right now. I think the Fed has kind of made it clear they're thinking more of 3, but we'll see, kind of how it goes. Nothing's certain. As we've seen when they went through the rate hiking cycle, things can go a lot faster or slower than expected. And then just, as a kind of a reminder here that I know a lot of us are hoping for rate cuts. Housing rates we would love to see come down. Car loans, any kind of loans. I know a lot of us are really, thinking that would be good, but most of the time the Fed cuts rates because the economy is slowing down, and so that's not necessarily bullish for equities. As you can see in this chart, there's usually a considerable pullback from the first rate cut to kind of where we bottom in the market here. There's usually about a 23.5% kind of correction. And so we want to keep our eye on that. I think the Fed holding is a good sign right now. We don't want them to cut. They're still thinking the economy is in a strong point to hold. And I think that would be most beneficial for the equity markets here.
Yeah. And Ty, let me ask you this, because through our blogs, we've talked about this, folks, is that the Fed is kind of paranoid because historically the mistake that's been made by the Fed, they lowered rates too soon and inflation came roaring back. You agree with me on that?
Yeah, that's correct. I heard today that earlier when inflation gets above 6%, there's typically a second wave. And we talked about that second wave before. That doesn't mean it has to happen this year. But there could be a second wave next year. And so the Fed and Jay Powell are really trying to avoid that second wave is their main goal here.
Yeah, I think that is a big issue with them. So folks, you need to be aware of that. And so these money market and bond rates that you're seeing, as well as dividend rates, we're keeping a close eye on those in relation to your portfolio, in relation to your financial blueprint. We also want to thank you for watching this vlog, and we also really appreciate the comments we're getting about our social media on Facebook and Twitter and LinkedIn and YouTube and our podcast. We continue to want that feedback, as well as we appreciate you sharing it with others. And so we're going to keep you updated through this week. It's hard to believe we're now into February of 2024. And so we found out the groundhog has predicted an early spring. And we also hope that with that comes economic opportunities, as well as more travel and fun for each and every one of you watching today. We hope you have a great week, and we're going to keep you updated. Thanks for watching. Talk soon.